A backlog that grew $25 billion in 6 weeks just met a market that closed the day red anyway. Good morning. It's Wednesday, August 12th. I'm Nick Verducci with Eleanor Whitfield and Marcus Brooks. Grab your coffee, because today's a lot. We'll recap a Tuesday that looked calm on the index board and wasn't underneath it. Dig into CoreWeave's Blowout print and what it does and doesn't prove about the AI buildout, sit with Alphabet's Capex reckoning, and set up the number that decides the rest of the week. CPI, 2.5 hours after we sign off. First to scoreboard, and Marcus, this one's actually yours to close out.
I know where this is going.
You made a call Monday that we couldn't grade Tuesday because CoreWeave hadn't reported yet. Guide, no hedge. Group closes Tuesday higher. CPI risk or not, we have the data now.
We do. And I want the room to know the earnings part of that call was right, dead right. Revenue up 112%. Backlog jumping from $104 billion to $129 billion in 6 weeks. No hedging anywhere in that guide. That's exactly the print I was betting on.
But that's not actually the bet you made.
No. I bet the group would close Tuesday higher. And Tuesday's close was red, S&P down, Nasdaq down worse, Dow down. I built a call around earnings that didn't even hit the tape until after the bell.
So, the thing you predicted correctly couldn't possibly move the thing you actually staked the call on.
Correct. That's on me. I wrote a same-day close call around an after-hours event. Bad construction, not a bad read on the company. Take the loss.
I'll allow the distinction, but a loss is a loss.
It's a loss. Marcus drops to 11-10, and that snaps the 6-game streak.
Streaks end.
Eleanor holds at 12-9, still on that 2-game slide from Monday's oil call. Sarah's 0-1, Dave's 0-2, both still waiting on their next shot in the chair. And a housekeeping note, yesterday's calls, Eleanor's on core CPI and small caps, Marcus's on the AI infrastructure group closing today higher, are both calls about today's session, which hasn't happened yet at 5 a.m. peening, both graded tomorrow. On to the tape.
Tuesday's headline numbers were almost boring on purpose. S&P 500 down about 1/3% to 7,728. NASDAQ the laggard down 0.6 to 26,445. Dow off about 1/3, closing just under 53,800.
Boring how?
Boring in that none of those moves look scary on a chart. Not boring underneath. The VIX jumped almost 4% to 15.46. The 10-year climbed to 4.73, its highest since January, and Brent pushed toward $90. 3 separate markets all leaning the same nervous direction into CPI Eve.
And the equity story wasn't really about the index. It was about Alphabet, down somewhere between 3.5% and 4%, dragging the whole NASDAQ with it, on top of everything else going on with oil.
We'll get to Alphabet properly in a minute. What else moved?
A genuinely brutal day for on-holding, down more than 20%, its worst day on record, on a revenue miss and soft guidance. Coherent fell over 14% on import ban chatter, even with otherwise decent transceiver headlines. AECom lost 4.5% on trim guidance.
On the other side, Plug Power jumped 13% on a beat, Datadog surged 11.5% on results, and a wave of price target hikes. Pure Storage gained 7.5% on a hyperscaler design win. So it's not everything sold off. It's the same pattern we've been on all summer. Miss and get crushed, beat, and it's a coin flip whether you're rewarded.
Give me the one-line summary of Tuesday.
Energy up on oil, tech down on Alphabet and rates, VIX up on all of it, a rotation day wearing a calm index number as a mask.
Now the story that actually landed after the bell, and it's a big one. CoreWeave, Micro and Lumentum all reported within about an hour of each other Tuesday night, and all 3 beat.
CoreWeave's the headline. Revenue $2.575 billion, up 112% year over year. But the number everyone's actually trading is the backlog, $104 billion at quarter close, and management disclosed it's already grown to about $129 billion, including bookings signed since. That's $25 billion of new contracted revenue in under 6 weeks.
And the stock reaction?
Popped as much as 12% in after-hours trading, settled into a still strong high single-digit gain. Supermicro rallied about 8% on its own beat. Fiscal first quarter EPS guide of $1 to $1.10 against the street estimate of 76 cents. And Lumentum more than doubled its revenue on 1.6 trillion optical transceiver demand. 3 different links in the same supply chain, all confirming the same demand story on the same night.
And it wasn't just the infrastructure names.
Right, that's worth flagging before we get into the debate. H&R Block jumped as much as 15% on an upbeat fiscal guide. Cava climbed nearly 7 on an earnings beat. Sea Limited rose about 6 on record marketplace volume out of Southeast Asia. None of those 3 have anything to do with chips or clouds, so last night wasn't a single theme relief. Tax services, restaurants, e-commerce, and AI infrastructure all cleared the bar in the same few hours.
Which matters for the CPI conversation coming up too. That's a broader base of corporate strength walking into the print than the headline AI stocks popped framing gives it credit for.
I want to be precise about what that does and doesn't prove. It proves demand for AI infrastructure is real and broadening. Compute, hardware, and networking optics all clearing the bar the same night is a meaningful cross-check. What it doesn't resolve is the capital structure underneath CoreWeave specifically. $35 billion of debt on the balance sheet, a net loss that widened to $626 million this quarter, wider than a year ago. Free cash flow still deeply negative. A backlog is a promise to be paid later, not cash today. And the promise is now growing faster than the company's ability to physically build the data centers to fulfill it.
Power, not chip supply or customer demand, being the actual bottleneck is the part I'd push back on treating as a bear case. If the constraint is we can't build fast enough, that's a demand problem in the good direction. Wells Fargo kept a buy on this stock, with a $155 target after the print. The streets read, mostly, is that the backlog conversion story is intact.
Mostly is doing a lot of work in that sentence. Stock's still down about 20% over the last 3 months, even after tonight's pop. The market hasn't fully made up its mind, and I don't think one very good quarter settles the debate about whether debt-funded, negative free cash flow growth at this pace is sustainable if financing costs move against it.
I think you're underweighting how much $129 billion in contracted, not speculative revenue de-risks that story. This isn't a promise from a slide deck. These are signed commitments from real counterparties.
Signed commitments can still be renegotiated or slow-walked if a customer's own AI spending gets scrutinized the way Alphabet's just did. That's not hypothetical. It's the next story we're about to talk about.
There's also a physical constraint in here, not just a financial one. Give me that number again.
Active power capacity is at 1.5 gigawatts right now, guided to 1.85 or higher by year-end. That's the real ceiling on how fast the backlog can turn into revenue. Not chip supply, not demand. Electricity.
Which cuts both ways. It's bullish in that the constraint isn't, nobody wants this, but it's also exactly why I'd temper how fast anyone models that $129 billion converting. You can't build a substation on a guidance call.
So where do you two actually land? Is this print bullish, or is it a really good quarter sitting on top of an unresolved risk?
Both, and I don't think that resolves today. I need to see a quarter or two of the backlog actually converting to recognize revenue at pace before I call the debt story settled.
And I think the market's already telling you which way it's leaning. A double-digit pop on a print with a wider loss attached to it. Investors are pricing the growth, not the balance sheet, and I think that's the right call for a business this early in a real infrastructure build-out.
We're not settling that one on air. Watch the next couple of quarters backlog to revenue conversion. That's the actual scoreboard for this argument, not tonight's stock move.
Fair, Marker.
Quick human moment before we get into Alphabet, because I need it after that spreadsheet of a segment. My producer sent me a text at 4 a.m. that just said, CoreWeave, Alphabet, CPI, pick a lane. And I don't think she was wrong to be annoyed.
There is no lane today. It's a 6-lane highway.
And we're doing all of it before 8:30.
We are. Alphabet, this is the story sitting underneath everything else this week, because it's the same demand the CoreWeave print just confirmed, viewed from the other side of the invoice.
Alphabet raised its 2026 Capex guidance to a range of $195 to $205 billion, up from a prior $180 to $190, and well above where analysts had modeled it before the print. And for the first time since its 2004 IPO, the company posted negative free cash flow in a quarter, about negative $5.9 billion.
First time in over 2 decades. That's not a small line to cross.
It isn't, and the stock's told you what it thinks. down between 3.5% and 4% Tuesday alone, continuing a slide that started the day the guide came out. One analyst put it bluntly, if they raise Capex again the way they did last quarter, that's probably selling pressure. Full stop. The market has decided it wants to see the payback math, not just the growth story.
I'd separate two things that are getting collapsed into one panic. Management's own language is that this is supply-constrained spending against confirmed customer demand, not speculative building ahead of demand that may not show up. That's structurally different from "we're guessing." And it's the same signal CoreWeave just gave you from the vendor side. Real backlog, real bookings.
Sure, but the demand is real was never really the market's question with Alphabet. The question is whether a business built on high-margin search and ads should be running negative free cash flow to fund it, and how many more quarters of that Wall Street tolerates before the multiple has to come down regardless of how real the underlying AI demand is.
So is this the same pattern we flagged last week? Palantir gets rewarded for raising guidance, AMD and AppLovin and HubSpot and Trade Desk get punished for merely meeting it? Does Alphabet fit that same bucket?
It's actually a step past that bucket. Those were guidance disappointed stories. Alphabet's guidance was fine. The growth numbers beat. This is punishment for guidance that was too aggressive on the spending side, which is the newer, harsher version of the same instinct. The bar isn't just beat and raise anymore, it's beat, raise, and don't scare me on the Capex line.
Which I'll grant is a real shift in what the market's rewarding. I just don't think it changes the underlying thesis. The AI build-out is happening. The money's being spent by companies with the balance sheets to spend it, and CoreWeave's night proves someone's paying for all that capacity. Whether the stock reaction is fair in any given week is a separate question from whether the spending's justified.
We've now spent 2 segments on the same underlying question from opposite ends of the balance sheet. Is this a demand story or a spending problem? Hold that thought, because this morning's CPI is about to tell you something about the macro backdrop both of these arguments are sitting on top of.
Which is my beat, so let's get into it. The 10-year yield closed at its highest level since January Tuesday, around 4.73%, even though Fed funds futures have a September rate cut prices close to certain. That's an unusual split. Fred End says easing, long end is climbing anyway.
Why would that happen at the same time?
Oil. Brent's push toward $90 on the Hormuz standoff is doing exactly what an energy supply shock always does to bonds, pushing a term premium back into the long end, because the market's worried inflation stays stickier than a rate cut alone would suggest. 2-year yields anchored around 4.19, basically pricing the cut. It's the 10-year that's fighting it.
And credit isn't pricing any of that worry, which I think is the more interesting tell. High-yield spreads are sitting around 275 basis points, near the richest decile of history. Investment-grade spreads near 80 basis points, tightest in a generation. If bond investors were actually scared about growth, credit would be the first place it showed up, and it isn't showing up anywhere.
Which tells you the market's whole worry right now is rates and inflation specifically, not a broader credit or growth scare. And that's exactly why this morning's number matters more than a typical CPI print. It's the referee for which signal is right, the front end's calm or the long end's climb.
Give me the number in one breath so people know what to watch at 8:30.
Consensus has headline C, PI at 3.4% year over year, cooling from 3.5 in June, up 0.2 month over month. Core's expected around 2.5% year over year, down from 2.6, also up roughly 0.2 on the month. Prediction markets are leaning toward that cooler outcome. Not a hot surprise.
And if it comes in cooler than that, I think you get a real relief rally across both the growth names we just spent 20 minutes debating, Alphabet included, because it takes some pressure off the Capex plus rising rates squeeze Eleanor's been describing all morning.
And if it's hot?
Then the 10-year move Tuesday wasn't oil noise, it was the market front-running a genuine problem, and I'd expect today to look a lot uglier than yesterday did.
Let's close the loop on this morning specifically. Futures, oil, and what else is on deck before the number drops?
Futures are actually leaning positive into the print, which is a little surprising, given everything we just said. S&P futures up around 0.2%, Nasdaq 100 futures up closer to 0.5%, Dow futures up around 56 points. Read that as positioning for the consensus cool scenario, not complacency.
Oil's still the wild card sitting on top of it. Brent's above 89, WTI near 84, and Hormuz headlines are genuinely mixed this morning. Tehran's still refusing direct talks with Washington, but Qatar's foreign ministry says Oman brokered talks with Iran are now in an advanced stage. That's the kind of headline that can move oil 5% in either direction before lunch.
And tonight, after CPIs had all day to work through the tape, Cisco reports.
Cisco's the other AI-adjacent name worth watching today, and it's a genuinely good setup. They've already raised their full-year AI infrastructure order forecast to $9 billion from $5 billion, and full-year revenue guidance to $62.8 to $63 billion, both ahead of where the street had them. Analysts are modeling around $16.8 billion in quarterly revenue and $1.17 in adjusted EPS. Last quarter, service provider and cloud orders were up over 100%, networking orders up more than 50%. If tonight extends that pace, that's a third supply chain data point, pointing the same direction in 1 week.
What would make you doubt the streak instead of confirming it?
Any hedge on the order revenue timeline, Cisco saying bookings are strong but pushing recognition out further than expected. That's the same tell Eleanor is watching for on CoreWeave's backlog, just one link further down the chain.
And I'd add watch the margin, not just the top line. Networking hardware at this order volume can grow revenue while still compressing margin if input costs or discounting are doing the work. A clean beat needs both.
So today's actually a two-part test. Can the number this morning avoid reigniting the yield story Eleanor just walked through? And can Cisco tonight extend the AI infrastructure confirmation streak CoreWeave and Lumentum started Tuesday?
That's the whole day in one sentence.
Let's get to calls. And since today's own session is still an open question for both of you from yesterday, these are for tomorrow, Thursday. So we've got something fresh to grade once today's dust settles. Eleanor.
Mine's on the 10-year. If CPI comes in at consensus or cooler today and the 10-year still can't get back below 4.7 by Thursday's close, I think that confirms Tuesday's yield climb was mostly an oil and term premium story, not a data story, and it means rate-sensitive sectors stay under pressure into next week, regardless of what the Fed actually does in September.
Marcus.
Mine's on the AI infrastructure group specifically. If Cisco's numbers tonight confirm the same order strength CoreWeave and Lumentum showed Tuesday, I think that group, NVIDIA, CoreWeave, the whole complex, closes Thursday higher as a group, and this time, I'm not building the call around an after-hours event I can't grade same day. Thursday gives the market a full session to trade all three prints together.
Noted. Better construction this time. 2 calls, 2 different lenses on the same underlying question. Is this week's AI infrastructure confirmation strong enough to outrun a rate story that's been quietly getting worse since Monday? We'll know by Thursday night. Here's where we actually are. Tuesday's calm index number hit a real rotation into energy and out of growth. CoreWeave, Supermicro, and Lumentum delivered the best single night of AI infrastructure confirmation in weeks. Alphabet's Capex reckoning shows the same demand story looks very different from the buyer side of the ledger, and the 10-year yield climbing into a rate-cut-friendly CPI print from the buyer side of the ledger, and the 10-year yield climbing into a rate-cut-friendly CPI print is the one number that can overweight everything Quack betted at. Watch the 830 print. Watch whether the 10-year holds below 475, and watch Cisco tonight for the third leg of this week's infrastructure story. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and you can find our written notes at novaventures.us. That's your Wednesday morning brief. Have a great one, and we'll see you tomorrow.